Here's the thing. Most people genuinely believe they're doing the right thing with money. They save. They avoid risk. They keep cash aside for emergencies. They follow the advice they've heard their entire lives. And yet, year after year, they feel like they're falling behind. Not dramatically, not all at once, just slowly, quietly, almost invisibly. And that's the scary part, because when something is visibly wrong, people fix it. But when something feels safe, familiar, and responsible, no one questions it. Look, almost everyone has been told the same rule. Build a solid emergency fund. Keep it safe. Keep it liquid. Don't touch it unless something goes wrong. That sounds sensible. It sounds mature. It sounds like the opposite of financial recklessness. But here's what most people don't realize. Safe money isn't neutral. It's doing something to you every single day. And in the world we're living in now, that something is loss. Not dramatic loss, not market crashes, not headlines. Quiet loss, the kind that compounds. Now, when people hear that, the first reaction is usually defensive. They think, well, I'm not trying to grow my emergency fund. It's not an investment, it's insurance. That makes sense emotionally. But emotionally correct decisions are not always mathematically correct ones. And this is where it gets really interesting. Because the problem isn't that emergency funds exist. The problem is how they're designed, how they're sized, and how they're mentally treated. Let's talk about inflation for a moment. Not the scary headline version, just the boring real one. Over the past few years, inflation across major developed economies has averaged somewhere around 4%, sometimes higher, sometimes lower, but consistently higher than what most people earn on their savings. At the same time, the average savings account paid roughly 1 to 2%, occasionally more, briefly with conditions attached. But for most people, most of the time, cash lost purchasing power every single year. That means even if you did everything right, even if you saved diligently and avoided unnecessary spending, your money still quietly shrank. And this is where people misunderstand what that actually means. When we say your money lost value, we're not talking about numbers on a screen going down. We're talking about what your money can buy. The same amount of cash buys less food, less fuel, less rent, less health care, less freedom. That erosion doesn't feel painful day to day, so the brain ignores it. But over time, it's devastating. Because the loss doesn't show up as a bill. It shows up as you needing to work harder later for the same life. Now let's put a real number on this because otherwise it stays abstract. Imagine you keep $20,000 in cash because you want to feel safe. If inflation runs at 4% and your savings account pays 2%, you're losing about 2% in purchasing power per year. 2% of 20,000 is $400. That's $400 of silent loss every year. Not because you made a mistake, not because you bought something stupid, because you parked money and assumed it was neutral. Now scale that. A lot of people hold 40,000, 60,000, even 100,000 in cash because they want maximum peace of mind. And what they don't see is that peace of mind has a price tag. If you have 60,000 sitting idle and you're losing 2% of purchasing power annually, that's $1,200 a year. That's a decent holiday. That's multiple months of groceries, and that's a car repair. And you didn't spend it, it just evaporated quietly. Now add opportunity cost on top of that. Because while that money is sitting still, other parts of the economy are moving. Wages adjust, asset prices rise, interest compounds elsewhere. And suddenly safety starts to look expensive. This is the part most people avoid thinking about because it feels uncomfortable. But the moment you stop treating cash as morally good and start treating it as a tool, you start seeing that there's an optimal amount. Not zero, not infinite, optimal. And here's the key question most people never ask. How much cash do you actually need to solve real emergencies in your life? Not hypothetical disasters, real emergencies, like a car repair, a medical bill, a rent gap, a short job interruption. If your emergency fund is meant to buy time, then the amount should match the time you realistically need. Not the worst case scenario your anxiety can imagine. Because anxiety has no ceiling. It will keep demanding more and more cash until you feel safe. But safety is not a feeling, it's a structure. Now here's where psychology steps in and makes things worse. Your brain categorizes money. It puts it into mental buckets. Spending money, savings money, investment money, emergency money. And once money enters the emergency bucket, it becomes untouchable. Not just practically, emotionally. People stop evaluating it. They stop optimizing it. They stop questioning whether the amount still makes sense for their life. The emergency fund becomes sacred. And the bigger it is, the more responsible people feel. But here's the trap. Feeling responsible doesn't mean you're being effective. In fact, safety-seeking behavior often leads to overallocation to cash because uncertainty feels scary and cash feels comforting. This isn't just bad habits. It's basic psychology. Loss aversion means people fear losing $10 more than they enjoy gaining $10. Ambiguity aversion means people prefer a guaranteed small outcome over an uncertain better outcome, even when the odds are in their favor. And recency bias means if you've lived through layoffs, rate hikes, or economic shocks recently, your brain overweights that memory and demands more safety now. So you oversave in cash, not because you're irrational, but because your brain is trying to protect you using the simplest, oldest tool it understands: cash. And banks quietly benefit from this. Idle cash costs banks almost nothing. They pay you a small percentage, then lend that same money out at much higher rates. Mortgages, credit cards, business loans. Your safe money is working very hard, just not for you. This isn't a conspiracy. It's how the system works. And the more cash people hold unnecessarily, the more the system rewards institutions, not individuals. Now, the story changes depending on where you live, but the pattern is the same. In the United States, people are encouraged to keep large emergency funds, partly because healthcare costs are unpredictable. And that's fair. The U.S. system can absolutely ruin people. But here's what rarely gets discussed. Most medical emergencies are not paid in cash up front. They're financed. They're billed later. They're negotiated. They're put on payment plans. Hospitals send statements. Insurance processes claims. You get a balance, then you choose how to handle it. So what happens in practice is that a lot of people hold massive cash reserves for medical emergencies while also living in a system where bills usually arrive after the fact. Again, emergencies are real. But holding excessive cash for events that are often financed anyway is usually inefficient. And worse, it creates a false sense of security because the real protection in the U.S. often comes from understanding the system. Knowing you can negotiate, knowing you can request itemized bills, knowing you can appeal insurance decisions, knowing you can ask for charity care if eligible, and knowing how your deductible and out-of-pocket maximum actually works. A lot of people don't do that. They don't learn the system, they just hoard cash, which feels safe but often isn't the smartest protection. In the United Kingdom, many people rely on cash ISAs for safety. On paper, they're tax efficient, but in reality, the interest often fails to keep up with inflation. So people feel protected because they're avoiding tax while ignoring the larger loss happening through purchasing power erosion. It's like celebrating that you saved a little on fees while a bigger leak is happening in the background. And there's another UK-specific issue. A lot of people treat cash ISAs like a permanent do-not-touch vault. So the balance grows, but it never gets reviewed. The original purpose might have been short-term safety, but it slowly becomes long-term stagnation. In Australia, this problem takes a slightly different form. Offset accounts exist, and they're incredibly powerful. They reduce interest on your mortgage dollar for dollar. In theory, they're one of the most efficient uses of spare cash. If your mortgage rate is 6% and your offset saves you 6% after tax, that's a hard return to beat with guaranteed safety. So you'd think everyone would be using offsets strategically. But here's what actually happens. People dump all their spare money into offsets and then mentally treat it as untouchable savings. They don't rebalance. They don't reassess. They don't consider whether some of that money could be working harder elsewhere, depending on their risk tolerance and timeline. The offset becomes a psychological lockbox instead of a strategic tool. And here's why offsets get underused or misused. First, the money feels gone. People can technically access it, but emotionally they treat it as locked. Second, people confuse offset with redraw. An offset is your money in your account, instantly accessible. Redraw is accessing extra repayments, and redraw policies can change. Some people get burned by redraw restrictions and then overcorrect by holding cash outside altogether, even when an offset would have solved the problem. Third, the bank UX encourages passivity. You see your loan balance, you see your offset balance, but you don't see the why. You don't see the long-term plan. So people just stack money in the offset and stop thinking, which is better than leaving it in a low-interest savings account, but it can still become excessive, especially if you're holding a year of expenses just in case, while other financial priorities are starving. In Canada, the issue often shows up through housing concentration. So much net worth is tied to property that people overhoard cash for safety, fearing market downturns, job losses, or interest rate hikes. But by holding excessive cash, they often slow long-term wealth accumulation while still remaining exposed to housing risk anyway. So the behavior creates the illusion of control without actually reducing the biggest exposure. Different systems, same behavior, overestimating how much cash equals safety. Here's the truth most people never hear. The purpose of an emergency fund is not to eliminate risk. It's to buy time. Time to think. Time to adapt. Time to avoid panic decisions. That's it. It's not there to make you feel calm forever. It's there to prevent bad decisions when something goes wrong. Once you understand that, the entire strategy changes. Because you don't need years of living expenses sitting idle to buy time. You need a buffer. You need flexibility. You need options, and options come from systems, not piles of cash. Let's make this practical. What does an emergency actually look like for most people? It looks like an unexpected expense that you can't cover from regular cash flow. A car repair, a medical gap, a rent increase, a flight home for a family emergency, a short period of reduced income. These are usually measured in thousands, not tens of thousands, and they often unfold over time, not instantly. So the right question isn't, how much cash makes me feel safe? The right question is, what problem am I trying to solve, and what's the cheapest way to solve it without panic? Because if your emergency fund is buying time, then the amount should match your time horizon. If you have stable employment, strong insurance, and access to credit, your required cash buffer might be smaller. If you are self-employed, variable income, single income household, or have dependents, you might need more. But even then, the point is not to hoard indefinitely. It's to design a system that adapts as your life changes. This is where smarter safety comes in. Instead of one giant emergency fund, safety can be layered. Some cash for immediate needs, access to credit for short-term shocks, low volatility assets for medium-term flexibility, income adaptability for longer-term resilience. That's real safety, not money frozen in one form forever. And let's clarify what layers actually means, because people hear that and think it's complicated. It's not complicated. It's just honest. Cash handles today problems. Credit handles this month problems. Low volatility savings and liquid investments handle this quarter problems. And adaptability handles long-term problems. Most people try to solve every problem with one tool, cash. And that's why they end up with too much cash doing too many jobs badly. Now, people often push back here. They say, but what if everything goes wrong at once? That fear is understandable. But here's what most people don't realize. In almost every crisis scenario, liquidity comes from multiple places. Credit markets adjust, governments intervene, payment structures change, banks create hardship arrangements, lenders offer deferrals, employers sometimes offer redundancy packages, insurance claims exist, and even when things are ugly, the world rarely demands all cash up front, all at once, on day one. The worst financial outcomes usually don't come from not having enough cash. They come from panic, poor timing, and forced decisions. Selling assets at the bottom, taking expensive debt because you waited too long, making permanent choices during temporary stress, and excessive idle cash doesn't protect against those. Knowledge does, preparation does, a system does. Here's the uncomfortable part. Risk isn't the opposite of safety. Ignorance is. Playing it safe without understanding the cost isn't conservative. It's expensive. And the longer this goes unexamined, the more it compounds. Now, what can you do practically without doing anything extreme? Start with this. Stop asking how much cash you're supposed to have. That number is generic. Your life isn't. Yeah. Ask how much time you actually need if something goes wrong. Do you need 2 weeks to find your footing? A month to stabilize? 3 months to job hunt comfortably? Then define the buffer based on time, not fear. Then look at what flexibility really comes from in your situation. Income stability, credit access, support systems or insurance, skill portability, those matter just as much as cash, often more. For example, if you're in a country with strong unemployment support, your emergency buffer can be structured differently than in a country without it. If you have a secure role and a strong professional network, your time to recover might be shorter. If you're in gig work or contract work, your system might prioritize a larger buffer, but still reviewed and intentional. And here's a key point. People forget to review. They build an emergency fund once, and then they never recalibrate. They get a raise, their expenses change, their life changes, their risk changes, their health changes, their dependence change. But the emergency fund just sits there like a shrine. So set a simple rule. Review your safety system on a schedule. Not daily, not obsessively, just a simple check a few times a year. Ask, does this still match my life? Because financial safety is not a one-time achievement. It's a living system. Finally, let every dollar have a job. Even safety money should be intentional, reviewed, and adjusted as life changes. If some of your cash is truly today money, keep it liquid. If some of it is time money, consider whether it can sit somewhere that at least reduces your biggest guaranteed cost. If you're paying high-interest debt, cash sitting idle while you pay high interest elsewhere is often a quiet leak. If you have a mortgage and an offset account, cash that sits outside earning little while you pay mortgage interest is often an avoidable leak. If you have no debt and stable income, you might be able to keep a smaller cash buffer and let the rest work harder, depending on your risk comfort. Money isn't a comfort blanket, it's a tool. And the people who quietly fall behind aren't reckless spenders. They're cautious savers following outdated rules in a world that's changed. If this made you rethink safety even slightly, that's a good thing. Because the most damaging financial mistakes aren't dramatic. They're quiet. They feel responsible and they compound. And if you're listening to this and thinking, okay, I might be doing this, don't panic. That's the point. This isn't about shame. It's about upgrading your strategy to match the reality we're living in now. Because safe doesn't mean smart. Safe means understood. And once you understand the hidden cost, you get to choose more intentionally. That's how you stop falling behind quietly.